Hello and welcome to Moneylife. This is Sucheta Dilal. This week, I'm going to discuss about an order that seems to have got lost and hasn't seen much discussion in the public domain. But it has a serious impact on all of us because we depend on credit ratings, especially if you're going to buy non-convertible debentures as an individual. And remember, your mutual funds are looking at credit ratings when they make bigger investments. And if you think mutual funds are here, then this ought to worry you. So, what happens in India? Our market scandals often arrive one after the other in rapid succession, and each new controversy buries the previous one. So, the last month has been full of excitement. There was Jane Street, the US-based trading powerhouse, which faced regulatory heat from the Securities and Exchange Board of India. It made global headlines. That hardly, finished the headlines, and you had the new one, which is Viceroy Research and its blistering attack on the Vedanta Group, which is a mines and minerals group headquartered now in the UK. In the process of analyzing these two and the volley of articles from Viceroy especially, we forgot all about this order of 27th June 2025. Why is it important? Because the Securities Appellate Tribunal delivered a damning verdict against the Securities and Exchange Board of India. It quashed SEBI's order against Rajesh Mokashi, who is the Managing Director and CEO of CARE Ratings. CARE Ratings is one of India's 7 credit rating agencies. It's not just that, it is the words of the order. SAT called SEBI's action a misadventure and a colossal loss of judicial time and resources. That's not all. It asked the regulator to pay 5 lakhs in costs to Mr. Mokashi for the miserable trauma inflicted on him. We've written all about this. You can read it in our digital magazine, Moneylife. Now, it's very likely that SEBI will appeal that decision. It usually appeals all orders that go against it. But this order caps a saga that began in 2018. And that's when we had this serious catastrophic collapse of a number of companies, starting with the 340 plus entity conglomerate, infrastructure, leasing, and financial services. That is a story Moneylife broke, the first default in 2018, and it triggered a systemic shock to the financial markets. It turned out that while IL&FS itself was like this giant octopus, it wasn't alone. It was not an exception. In quick succession, you had the collapse of Diwan Housing, Yes Bank, Reliance Communication, and many more. We won't go into it because we are discussing ratings over here. In all of these, including IL&FS, there was a AAA rating, which is the highest rating that you can get. And overnight, it was a default. And the credit rating agencies were obviously caught sleeping at the wheel or absolutely incompetent and not doing their job, having ignored warning signs. Who bears the consequences? Obviously, investors. Investors, creditors, mutual funds, institutional investors, corporate treasuries, all of them invest on the basis of AAA ratings, AA ratings. In fact, many of them are not allowed to invest in paper that is below AA. So the ratings are absolutely important for the viability of the financial market. And these are the agencies that are caught napping. So under pressure to act, obviously the series of collapses, SEBI, which regulates credit rating agencies, launched a series of probes. So it launched a probe against ICRA, CARE, and India Ratings and Research. It issued circulars to tighten compliance, improve ongoing disclosures, levied fines, gave the marching orders to a couple of MDs, including Mr. Mokashi. And yet, as we stand today, we're going to ask the question asked in the 2011 film, Who Killed Jessica Lal? Or, in this case, who killed the rating system? If nobody was pressured, as per the SAT order, no undue influence from anybody was exerted, then were the rating committees simply incompetent? And has that changed? What does it mean for us? Can we trust credit ratings today? In order to answer that, we need to retrace our steps back to the regulatory journey that started with the embarrassing disclosures of 2018. So, what got SEBI into crusader mode? In early 2019, the Parliamentary Standing Committee on Finance, that time headed by Veerappa Moily, an opposition leader, looked at all of this issue with much shock and concern. It came up with a sharply worded report which was titled Strengthening the Credit Rating Framework in the Country. This obviously was embarrassing for SEBI, and it put it in a crusader mode. SEBI responded by the investigations that I talked about. So it charged CARE, India Ratings, and ICRA with lethargic indifference and laxity. So it had imposed initial fines of 25 lakhs on each of them. These were later increased to 1 crore. In fact, in one case, India Ratings, SAT actually upheld the SEBI penalty and enhanced it to 1 crore. SEBI then issued winding up order against another rating company, different from this, Brickwork Rating, which is a smaller rating agency. So in October 2022, SEBI actually decided that this rating agency just needs to be wound up. Like always, they rushed to appeal. SAT immediately quashed the order in June 2023 and sent it back to SEBI to reconsider its decision. Now, when reconsidered, SEBI decided, okay, we are not going to ask it to wind up, but imposed severe operational restrictions, including a freeze on new clients. The CEO then was changed, the board expanded, corporate governance issues looked at, but it's still around. And I think the restrictions still continue. Now, SEBI also simultaneously issued sweeping reforms, right? So faster rating reviews, stronger documentation, public disclosure of methodologies, enhanced surveillance, rotation of key analytical staff, and publishing the probability of default for each rating. It also attempted to plug some gaps. For instance, the excuse that the issuer is not cooperating. So a lot of times the ratings remain because rating agencies say we wrote to the issuer, they don't write anymore. If things are wrong, they don't cooperate. And that used to be an excuse for an old rating to be stuck, SEBI, and avoid downgrading. So SEBI has tried to fix that as well. Is all this going to work when they can challenge SEBI orders? Because the point is, it's okay to have rules, you need enforcement. And none of the rating agencies have admitted to any wrongdoing. They've all contested SEBI's orders and fines, paid the fines without prejudice, and looked at long drawn appeals with great success, barring an occasional example. Because SEBI's cases seem to unravel in appeal. In June 2021, SAT slashed the 1 crore penalty on CARE ratings. This was for delaying the downgrade of Reliance Communications when Moody's had already downgraded it from 1 crore to 10 lakhs. Not even a slap on the wrist. When SEBI tried to appeal to the Supreme Court, it wasn't even admitted. The appeal was simply dismissed without hearing, saying it won't be a precedent. And that is how the judiciary seems to help rating agencies. Now, the SAT order of 27 June 2025, which is the subject of this video blog, which exonerated Mr. Mokashi, is now part of a familiar pattern. You're punished, you appeal, and if nothing else, you get a lot of relaxation. This raises serious questions about SEBI's investigative rigor, legal strategy, and its capacity to hold fiduciary agencies accountable. So let's analyze this order. Was there regulatory overreach? Sadly, it appears like it. So, going back to when it started, April 2023, SEBI barred Rajesh Mokashi of CARE from market related roles for 2 years. Also barred the chairman. He resigned. SEBI alleged that he had interfered with the rating process and the decisions. Under SEBI's direction, CARE was asked to conduct an independent inquiry. So, they appointed former Supreme Court Judge Justice B.N. Sri Krishna to conduct this inquiry. This inquiry comprehensively exonerated Mr. Mokashi. In fact, it said there is no material to suggest that Mr. Rajesh Mokashi interfered with the process of rating and influenced the outcome of the rating committee's decisions. This means that all the cross-examination and material that was put before Justice Sri Krishna did not give any evidence against him. What should SEBI have done? Should it have accepted it? I think so, unless it could find something else, which is a real red flag, a recording. Instead, SEBI did another internal inquiry, did an interpretation of Justice Sri Krishna's exoneration, and said, we are going to punish Mr. Mokashi, and issued another order. This was done by the whole time member, leading to a hugely embarrassing outcome at the Appellate Tribunal and the fine imposed on SEBI itself. In fact, if anything, this episode underscores a chronic issue with SEBI investigations. There's a problem, which is that SEBI's propensity to outsource the commissioning of sensitive investigations to the very company, institution, exchange which is under investigation. What does this mean? That I'm under investigation. I'm asked to appoint a forensic auditor, or in this case, Justice Sri Krishna, pay for the inquiry, and ask them to investigate me. How does this work? So, in the infamous co-location scam, again broken by Moneylife in 2015, which was at the National Stock Exchange, we have written a lot about it, including our book, Absolute Power. What did SEBI do? It had first an inquiry done by two IIT experts ordered by its Technical Advisory Committee. For some reason, it didn't continue with them. It asked the NSE to appoint first Deloitte, then Ernst& Young, then ISB Hyderabad, which is a management school. And obviously, there were allegations of conflict of interest, dragged on, nothing much came out of it. There were people on the NSE board at that time who were on the boards or had donated money to ISB, for instance. It lacked credibility. So at least two audits really raised concerns. Same with the Jane Street investigation. Now there are two exchanges. This is where trading happens. The exchanges, yes, are first line regulators, but SEBI has to investigate all of it. Instead, NSE is asked to conduct an investigation and BSE is asked to conduct an investigation. And then SEBI is going to analyze that and come up with its order. In credit rating, it's a long held concern that those who pay for the rating call the shots. He who pays the piper, as they say. The same applies to consultants, forensic auditors, and whatever. It has been a concern that is discussed at SEBI's primary market advisory committees. I was a member over 20 years ago. Nothing changes. SEBI continues with what is questionable. In fact, a retired banker who headed a institution says this to me. It is absurd to ask an accused to commission its own investigation. SEBI could have directly engaged reputed firms to conduct the investigation. At worst, the cost could have been borne by the institution later if found guilty. But SEBI itself has enough money to do this. So let's now come to systemic issues. Why was nothing found? So there's an issue with how and who investigates. Now let's look internally. Rating decisions are made by committees ostensibly governed by documented protocol. It's very good. But these protocols often leave room for discretion and judgment. In India's opaque financial ecosystem, rating mandates follow a pecking order. Everybody knows about it. It's about relationships. It's about costs. It's about somebody being stricter. You go to others. It's less about just playing tic-tac-toe and deciding who gets it. This complicates enforcement. Group decisions are designed to create plausible deniability, which is the whole group decides. So how do you say one particular person was rooting for something or there was influence? In fact, group decisions, as in ratings, are even harder to prove than insider trading, which is pretty tricky. The challenge is even greater when courts treat credit ratings as an informed opinion and their rating failures as regrettable decisions rather than a fiduciary failure which has impacted a whole bunch of other decisions. Our courts obviously seem unaware about how ratings work, and here I also blame SEBI because SEBI's lawyers should have argued and created this sensitivity and information at least over the last 20 years. What this means is it sets an impossible threshold. Unless officials are actually caught on tape dictating downgrades or upgrades, you get WhatsApp messages or something, it is impossible to prove what is decided by a committee in a group. What does SEBI do instead? It takes mitigating action, which is strengthen the regulatory framework through sweeping amendments, which is all very good. But the events of June 2025 suggest that rating agencies are bound to feel emboldened by judicial decisions. I mean, why won't you? If decisions go in your favor, even if there are rules, why would you worry? Not a single senior executive has been held for serious, egregious rating collapses that destroyed investor wealth and investor confidence. Will SEBI's disclosure focused reforms be enough to prevent the next rating debacle? Unlikely. The brutal truth for Indian investors is that credit ratings cannot be blindly trusted. They must, at best, be treated as a starting point and not a shield against risk. Every investor, and imagine how tough this is for retail investors, will have to do their own due diligence. Lenders, mutual funds are in a better position to do this, but they will need to treat even AAA rated instruments with caution, having learned from the past, in order to be in order to avoid being blindsided by rating failures. Now, SEBI has changed the rules, but India has never lacked for rules. We have more rules, more red tape than required. Without credible enforcement that passes legal muster, fiduciaries will continue to fail and investors will continue to be exposed to financial debacles. And at the end of it, after 10 years or 7 years or whatever, nobody will be held guilty and we will be back to asking a similar question like who killed Jessica Lal? If this worries you, I think you need to be careful about your investments. And in order to know more like this, do subscribe. Thank you.